Hello, and welcome to Your Money 2.0. I'm Thomas Fox, Community Outreach Director of Cambridge Credit Counseling. As we've reported previously, the Credit Card Act of 2009 was enacted last May to deal with what the administration deems unfair and deceptive practices in the credit card industry. With most of the changes scheduled to take place in February 2010, you might think that the banks have been busy adjusting their policies to meet the requirements of the new law. As a recent report from the Pew Charitable Trusts reveals, many banks are using this waiting period to adjust their policies in a way that will help them secure their bottom lines as the economy continues to struggle. The report, which is titled Still Waiting, Unfair or Deceptive Credit Card Practices Continue as Americans Wait for New Reforms to Take Effect, update the Pew Trust credit card report from December 2008, and reviews the policies of those banks that control more than 90% of the outstanding credit card debt in America. Amazingly, 100% of the banks reviewed would fail to meet the requirements of the new Credit Card Act. In fact, some of the practices that brought about the credit card legislation have become even more common. For instance, in December 2008, 92% of the banks reviewed raised interest rates on outstanding balances by changing their account agreements unilaterally. As of July, 99.7% of the banks will raise their rates. The report also found that 95% of the banks covered in the study apply payments in a manner that the Federal Reserve considers likely to cause substantial monetary injury. This means that the credit card issuer chooses how to apply your monthly payments. That's possible because many accounts have multiple types of balances, each with its own interest rate. For instance, the interest rate that you may be charged for purchases could be 15%, while the interest rate for any cash advance could be 25%. Your credit card company decides where to apply the bulk of the payment, and right now, many apply payments to the portion of your balance with the lowest interest rate first. Let's assume you had a total credit card balance of $1,000, $600 of which was for purchases, and the remaining $400 for cash advances. You then made a payment of $700. The bank would choose to apply the payment to the portion of the balance related to your purchases, the part with the lowest interest rate. The balance with the higher interest rate, in this case the cash advance, would receive a smaller payment. The Credit Card Act abolishes this practice, but until it takes effect, banks will continue to squeeze every dollar they can out of their accounts by applying payments this way. That's why Congress is considering moving up the effective date of the Act to December 1st. From the bank's perspective, making the most out of the credit card side of the business before that happens makes perfect sense. After all, their real estate lending business has been hurting and is slow to turn around. At the same time, the rising number of defaults, a natural consequence of increasing unemployment among the bank's clients, means that banks have good reason to be anxious about the changes they'll have to accommodate when the new law takes effect. And there are other changes you should be aware of. Creditors are also making a departure from offering consumers fixed interest rates. Most contracts allow the lender to change the interest rate they offer to you for any reason. Because of this, the Credit Card Act requires that rates advertised as fixed must remain unchanged for a stated period of time. To avoid this, some creditors are opting to convert their fixed rates to partially variable rates with fixed minimums. Partially variable rates are tied to an index like the prime rate, and the minimum rate requirement would prevent cardholders from enjoying a low rate if the index fell below a predetermined limit. In December 2008, the Pew report indicated that 10% of banks attach partially variable rates to their credit cards. However, in July 2009, 38% of the banks studied now offer partially variable rates. These are only a few of the items detailed within the Pew Trust report. I encourage you to visit www.pewtrust.org/creditcards to learn more about the Pew Charitable Trust Safe Credit Cards project and access a copy of Still Waiting. Well, that's it for this edition. We welcome your feedback and ask for your thoughts and suggestions by emailing us at yourmoney2@cambridgecredit.org. Thank you for watching. Until next time, I'm Thomas Fox for Cambridge Credit Counseling.